Well, today the markets were completely flat, waiting for the Federal Reserve's decision on Wednesday. But the big news now is there's a recession upon us. Is it behind us? Is it in front of us? And what happened the last 5 times we had a recession happening? That's what we're going to talk about in today's video. So my name is Dan Frio. I talk interest rates and mortgage products for you guys because I'm actually a federally licensed mortgage loan officer with our slogan, one application, one credit pool. We're going to shop your loan to over 30 different lenders. How do we do that? I'll give you all that information at the end of the video. What we're talking about today is why the market is stagnant. Well, we got the Federal Reserve coming out on Wednesday telling us what they're going to do. I'll be a spoiler. I'll tell you what they're going to do beforehand. But we're also going to talk about recessions. What happened? There was 5 previous recessions we're going to go over. What happened to interest rates and home prices? So should you sit on the sidelines waiting for the recession to be announced or the recession to actually come through, or isn't even worth waiting for? So let's figure that out. So right now, here's what we had today. The markets were completely stagnant when you're looking at this. You even go to the Dow Jones and the equity markets. I'll say a minus 98 on the Dow is stagnant. A minus 133 in the NASDAQ, we'll say that's stagnant as well because these things are moving by the hundreds per day. We got the VIX actually went up today as well. That's not good news when it comes to the anxiety levels on Wall Street. But the good news, well, I'll say, is mortgage rates were basically just flat on the day because everybody's just waiting for what the Federal Reserve's going to do. So instead of going over, what the bond market did and everything else, let's look at what happened over the previous recession. Okay, the reason being is a lot of people are saying now we are currently in a recession. So I want to teach you a little bit about what the previous recessions, why they occurred, and then what happened to mortgage rates and home prices. I think you're going to be a little surprised here. So let me get my head out of the way so you guys can see the full screen. So let's get to it. So this is basically an analysis of what mortgage rates did and home prices. So we got right through here, we got the blue, which are mortgage rates, and we got the orange or whatever you want to call that color, and that is home prices. So in 1980, we had a recession, and these are going to show you the recessions through here. But I want you to understand basically the whys they occurred, because you have to understand the whys to then figure out, well, is it going to occur again? Okay, so let's just go back and look at the whys from previous recessions, and then we'll try to figure out what this recession's all about, and then try to figure out or backfill the numbers on what potentially might happen to rates and home prices. So let's get over to here. In 1980, we had an oil shock, and the Fed tightened policies to fight inflation. Kind of what we're seeing now, but we don't have the oil shock. But the oil shock back in those days, I lived it. I was a kid. It was crazy. We had to get in line to fill up our gas tanks. I remember me and my mom, we'd sit in line for 20 cars deep to try to get gas. So that was basically an oil embargo that happened then. 1981 to 82, Fed aggressively interest rate hikes to end stagflation. So they jacked up interest rates at that time because of stagflation. And that's, maybe where we are now, but everybody's saying recession. So we'll keep moving on and seeing where the recession is. In 1990 and 91, there was a savings and loan crisis. We also had the Gulf War, and then we had some credit tightening by the Fed. So that's what occurred. It was like a bank failure in a war, and that pushed us into a recession. 2001 was the dot-com, where basically if you were in the tech boom, you exploded, or most of those techs blew up in people's face, and that's basically what happened. You lost millions and billions of dollars there, and all the markets collapsed. Now, the one piece of the puzzle, the area that everybody says, well, here it is again, we're back to this same category, is that price crash that happened in 2008, everybody says. And I keep saying, well, it was caused by the subprime mortgage crisis. It was just bad loans given to people that didn't deserve actually getting these homes, and that just clobbered the market. So that's what happened. So you have to truly understand how the subprime market crashed the market at that point, because we had huge growth in the market, nothing like, very similar to what we had during COVID, but those loans were underwritten with good lending standards. Back in 2007, they were not, and I can vouch for that. And then 2020, we had the pandemic. So let's get over to see what happened with all these. So in each one of these cases, let's look at it right through here. Oh, what's going on? Let me flick that. Okay. So we have, again, the blue are mortgage rates, and the orange is, I got to shrink it a little bit more. Let's go through there. Okay, so we should be able to see that now. So in 1980, we had mortgage rates. They jacked up. and didn't look like home prices did anything to write home about. 81, 82, we had mortgage rates coming down and home prices came down as well. And they came down, what does it look like? Maybe 2 or 3%. Right? So then in 1990 and 91, we saw mortgage rates come down once again. 2 out of 3 so far we have down. We have the housing market down a little bit. Maybe that's about 2%. Okay, during that recession. So we got 2 out of 3 better rates and 2 out of 2 for lower home prices. Okay, looking favorable for those out there waiting for home prices to come down. Now we get to 2001. What happened here? Well, mortgage rates, they eased a little bit and home prices, they rallied. So that was good news for everybody. Lower rates, higher home prices. Now here's that thing everybody banks, they're crashing everything on right through here. Okay, but if you take this out, just let's say for hypothetical purposes, you take this out. Markets are usually here, but let's just use this. Mortgage rates went down, home prices crashed. Why? You had a subprime mortgage debacle with foreclosures out the roof. And that's why I focus on foreclosures a lot, because unless you have a huge supply of inventory, you're not going to have anything near these price crashes like we've seen in that time. And you never saw it before in history. And hopefully because of the resolution in mortgage underwriting, you never see that again in the future. So let's look at this. You have 1, 2, 3, 4, 5, 6 recessions. 5 out of the 6, you had lower rates. Okay. You go to the home prices, 1, 2, 3, 4, 5 of them. You had 3, you had lower prices. 2, you had higher prices. Look at the price differentials here. If you take out, again, this anomaly, and this is what everybody's banking on. They're like, okay, it's going to be worse. And you'll see everybody's videos worse than 2008. Because that's the worst time we've ever had in history. And it's never happened before, and hopefully it never happens again because of the guardrails that they put in place. So that's what we're seeing right now in what has happened in the past during recessions. So now if you're sitting there saying, okay, should I wait? Should I do what? It's kind of a hard thing to say. But I do want to go over to CNBC. I want to show you this person right here. He's part of PIMCO. PIMCO is probably the biggest asset manager in the whole world. This is their bond market person. Let's get his take on what he thinks the economy is going to do. And are we in a recession? Are we getting in a recession? And what's going to happen if we go in a recession?
Well, stay on the markets, Carl, because joining me first here on Money Movers, we've got Manny Roman, the CEO of PIMCO. PIMCO oversees more than $2 trillion in assets under management. It's great to see you again here at
Thank
Milken.
you for having me. I'm delighted.
So Carl was just saying that the data this morning, services comes in better, but prices paid comes in hot. How concerned are you guys about an inflation flare-up?
Well, I think we're going to know a lot more at the end of May. There's a lot of uncertainty about tariff, and we may enter into a recession. We may already be in a recession. And so there's going to be this tension between the inflation coming from policies, and then at the same time, the fact that in a recession, of course, inflation becomes more subdued. Which one is going to win? We don't know. And we also think the Fed will react to this and will look at the data before they make decisions.
Okay, so you have a gentleman here that is the CEO of the biggest probably investment firm of the world, and he's telling you he doesn't know. So this is where I come out and I even tell you guys, I even tell my kids, it's okay to say you don't know. I hate when I see these people coming on and they're like, here's what's going to happen. And maybe 50% of the time it happens. I have no problem coming out, folks, saying, I'm going to wait for the data to come in. And that's why I'm actually on the side of the Federal Reserve. And I'm also on the side of President Trump. The Federal Reserve needs to lower the front end yield curve. But before they do that, they need to find out what's going to happen with tariffs and everything else. So let's get back to it.
We have a meeting on Wednesday. Data's not really clearly showing which one is the bigger problem right now.
No.
Inflation or growth.
No, it doesn't.
So what do you expect the Fed to do this year?
We think that in September, the Fed may decide to cut. We think it will
Not until September?
Not until September. We think it will be very data dependent. And I think the key we all have to watch is unemployment. If unemployment goes above 4.5%, and I'm not saying this lightly because people will lose their job and it's never a fun thing to watch. But if unemployment goes above 4.5%, then the Fed may decide to act. and cut and start into
But wouldn't that be too late if they wait until that happens?
not necessarily. Not necessarily. And I think also you need to balance the risk of going too early. And I think that's a real risk that the Fed is well aware on inflation.
So given that there are these two big uncertainties about the impact of tariffs and everything going on right now, how are you guys positioned at PIMCO around treasuries?
Well, I think we like fixed income, and there's a lot of things to do. So you can break the question into several parts. We like the fixed income market, and we are going to be able to deliver pretty good performance to our clients. We like the alpha opportunity. There's a lot to do. Some things look very cheap. Some things look more expensive. And so we should be able to pivot.
Cheap?
Tips, emerging market, if you think the dollar is going to be a little weaker, structure product, mortgages, asset-backed.
Student loans?
Potentially student loan. There's a lot to do. And we're going to be able to build pretty good portfolio for the next 3 to 5 years. And I think we're excited about that.
Where the 10-year treasury sits right now, up around 4.2 or so, where do you think it should be at this point?
It's a very hard question to answer because the tariff and what's happening with trade policy dwarf every sort of model in terms of what fair value is. Tariffs are usually inflationary, and so we need to think about what this will be. There's clearly deals coming with potentially Japan and Korea, and so there's a lot of uncertainty. And the uncertainty around the tariff is actually much bigger in terms of noise than other things going on in the market.
Okay, so that's that take on it. Then I'm not going to play it for you, but right through here, Secretary Besson, he comes in today and very close to some trade deals. So as these trade deals come in, you've been seeing PIMCO's CEO saying we have to wait for these models to come in to figure out what's going to happen. So short term, again, if you're getting a rate right where you are today and you don't want any huge fluctuations, lock in. But here's what we do for you. I'll go over to you and just bring you to my website. So my name is Dan Frio. I do these videos actually 2 times a day to inform you guys what's going on with mortgage rates, mortgage products, and real estate. I try not to get in what's going on with home prices because I don't know where you live. But what I try to inform you guys is and what's going on with mortgage rates and the whys behind it. So a lot of things are transpiring right now. So I'm on the fence. If you're looking short term to lock in your rate and you get a quote right now and you're closing in 2-3 weeks and you like it, lock in. Short, midterm, I'm going to wait till the end of May to figure out how all these tariffs, as tariff deals come in, we're going to be paying very close attention to it. The biggest piece of the puzzle we're going to also pay attention to is, inflation. It's a moving target right now because of tariffs, but the biggest piece of the puzzle we're watching is the employment numbers. And that's why Friday, when they came out at 150,000, I'm like, that's a great number considering, especially when we came off of the ADP numbers. So right now I'm looking at as May concludes and we get more and more clarity on tariffs, it's going to be good news. As long as, I'll put it this way, as long as there's really good news on tariffs, you're going to see the markets flow. And what I mean by that is you're going to see the equity markets going up. So you're going to see stocks rally, and you're also going to see less uncertainty or risk premium built into bonds. So you're also going to see interest rates come down. But it's going to be a moving target right now, probably for the next 30 to 60 days. So that's why you need to stay tuned daily to see what's going on with these things. And the best way to do that is just check me out on therateupdate.com. So like I said on the beginning of this video, I am a federally licensed loan officer. I work at a federal bank. But the unique thing about us is our slogan is one application, one credit pool. We're going to shop your loan to over 30 different lenders. How do we do that? Well, the federal bank that I'm set up with, we're set up with 33 other banks to basically pull all these programs together to help you guys navigate this buying environment. So if you don't want to reach out to 10, 15 different companies or banks to see what kind of rates you can get, and you just want to get one application, one credit pool, and up to 33 quotes, I'm your man. So go to therateupdate.com. Right above my head, you can put in the application. You can put in a one-on-one consultation call with me or Alan right through there. Give us a call at 844-775-5626 or scroll down and you're going to see just a handful of videos selected right through here that we've chosen of over 3,000 videos I have on my YouTube channel. So check those out. Check out these ones as well. But if you need some help when it comes to buying or refinancing your home, hopefully I can be your man when it comes to that mortgage. So thanks for watching, guys. God bless. Can't wait to see you back here tomorrow morning to see how this fiasco starts another day. Thanks for watching, folks. Take care. Bye-bye.